Stocks lower in early trading amid concerns over the U.S. government debt load. Our guest says, though, he is finding opportunities in U.S. stocks. He has three ideas for us. We're joined by Keith Gangl, Senior Portfolio Manager at Gradient Investments. Keith, great to see you. Thanks for joining us.
Thanks for having me.
Are you worried about the U.S. debt picture in the sense that it's likely to be an overhang for the markets?
Yeah, debt's been a little bit of an overhang for quite a while. Now, ultimately, we have to get our spending in line with how much revenue we're generating. We haven't done that for several decades, but at some point in time, the market's going to force its hand to actually focus on that. I don't think that's right now yet, but something to be aware of. Right now, where we spend about 13% of our federal revenues go into our interest expense. So as interest rates go up, we outspend what we have. That's why we're adding 1.5 to 2 trillion a year to our debt, which is actually at 36 trillion. So at some point in time, it'll become an issue. I'm not sure if it's an issue today, but certainly people have to be aware of it.
That's interesting. And of course, we see the 30-year bond yield moving up, and that essentially means increased funding for the costs for the U.S. economy.
Yeah, exactly. And that's what we have to worry about. If interest rates continue to go up, that's going to be more interest expense. And obviously that interest expense, if it goes from just a couple of years ago, it was at 5%. Now we're at, 12, 13%. If the forecast till 2035, it goes up to 16%. So that extra money is going to have to come out of somewhere else. I mean, the big budgets obviously are defense, Social Security, and healthcare services. Those make up almost 50%. So if you're talking 16% on interest expense, that doesn't leave a whole lot for more of that discretionary items that we'd have to pull back on as well. So again, it's becoming an issue, and that's why the government, especially the president's focused on getting interest rates lower, because then you can refinance at a lower rate, and that gets that interest expense from that 12, 13%, maybe back down to that 6, 7, 8%, which is manageable.
As of today, the S&P 500 narrowly back into positive territory for the year, up around 1%. But European stocks are ahead about 11% this year, depending what metric you use. Do you think this so-called sell America trade will continue?
I don't. I definitely think that's going to start rebounding as well. Obviously, the international market's been a laggard for several years to several decades. So valuations are cheap there. I think fundamentally things are just a little bit stronger in the U.S. than they are outside of the U.S. So I think as people get used to these new tariffs coming on, what's the tax policy going to be? I think the U.S. is still going to be the shining star on the hill.
That's interesting. Why the shining star?
Obviously, it's, their fundamentals are a lot stronger. Technology companies, for example, the Mag 7 companies make up, 25 to 30% of the overall S&P 500, the market. These are innovative companies that no one else has in the world. So people are willing to pay up. So that's why valuation's higher. The growth rate's higher in the U.S. Fundamentally, things are just stronger.
You have some ideas for us in stocks. Quanta Services, what do they do and why do you favor this one?
They're an infrastructure play on power. They're the build out of the grid. Obviously, as we continue to expand, we bring more manufacturing back plants. AI is driving the capacity that we have for any energy we produce is going to AI. They consume so much energy. So PWR Quanta is a play on that. They're building out the infrastructure. They just had a fantastic quarter. Bookings were better expected. They actually raised EPS when people thought, that they're a global player, but 91% of their revenue is actually in the U.S. Again, goes back to that pro-U.S. thesis we have.
Your next idea is Synopsys. What are they all about?
Yeah, that's an electric design EDA company. So as this AI and any chips that are built, you need a software around it to design and automate the actual end product. And that's where Synopsys plays. It's a great company. So again, that's kind of a backdoor play on AI as well. As AI becomes more efficient, more designs need to be made, more automation. Synopsys is the winner in that space.
And then your final idea, Accenture, the big consulting company with a focus on information technology.
Correct. And this stock's actually pulled back pretty aggressively here because 55% of their revenues is outside the U.S. So people are worried about tariffs and what kind of impact that would have if you'd go from national to, the companies actually investing in their own companies versus Accenture, which is a U.S.-based company. But we think fundamentals are still very strong there. They just recently had a decent quarter, raised a little bit of guidance. They were at a conference, too, talking about how AI is actually a beneficiary for them. Some people thought it would be a net negative for them, but they're usually ahead of the technology spend, and we think they'll continue to be ahead of the technology spend here in the AI space.
Finally, Keith, what are you looking out for this week? Any news points that you think investors should be keeping in mind?
Yeah, we got to see how earnings are playing out. Obviously, you just mentioned a little bit earlier, we set target. Some of the economic data we're, looking for the jobless claims and things like that. We think, again, there should become, expectations should be in line. Last week, we saw, CPI on the inflation side of things. That was slightly better. So we think that's actually a potential positive for the overall markets. We also got to keep an eye on the 10-year Treasury yield, where that's going. Thank
you very much indeed, Keith. Really appreciate it.
Thank you.
Keith Gangl, Senior Portfolio Manager at Gradient Investments.